makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. The dollar rallies against all of its G10 peers, sparked by geopolitical tensions and the prospect of rates staying higher for longer. Now, the latest data out of China suggests the economy is still struggling as the German Chancellor Olaf Scholz takes a tough stance in a trade meeting with President Xi Jinping in Beijing. Plus, Israel vows to respond with senior military officers saying the country has no choice but to hit back against Iran. Allies are urging restraint. So we have a lot of geopolitical news. Of course, that's playing out in the markets, but this is the picture overall for, of course, the European markets map. Now, what's moving these markets? Again, there's a little bit of a risk aversion out there. When you look at the FTSE, the DAX, the CAC 40, they're all down some 1.3%. In terms of asset classes, now the ones that we really need to keep an eye on, because we've seen a record high in a lot of these markets, is, for example, gold. We are also starting to get into earnings season. Again, I know that was fast. It feels like it was only yesterday that we had earnings day in, day out. But again, this wall of worry is really also following the sell-off that we had in Asia. And this is, again, a little bit of anxiousness out there about these elevated U.S. interest rates, but also signs of fading momentum in China's economy and these rising tensions in the Middle East. Now, S&P futures doing a better job at the moment of staying calm. The Nasdaq futures practically unchanged, but you can see really there is a bit of a sell-off in Europe. Gold is always, for me, a very interesting bet because sometimes it's counterintuitive. This used to be a play, almost a pure play against inflation, 2,367, and then you can see Brent 90.19. So European stocks tumbling today following the sell-off in Asia. Again, U.S. rates, the worries that they remain higher for longer, adding to the gloomy mood, signs of fading momentum in China's economy. So let's bring in our guest, Eimear Walsh, Mercer's head of investments for Europe. But Eimear, thank you so much for joining us. I mean, today's not a great day on the markets, right? Because there's this sentiment that creeps on grasping with basically a risk-off because they worry about interest rates, and there's this worry about geopolitical tensions.
Yeah, so I think geopolitics and market fall is front of mind for all investors at the moment. From our own perspective, that short-term volatility isn't creating huge concerns. We've seen red across the board, but what we're really focused on is what's going to happen to inflation. So all eyes are on that oil price, any supply shocks. Markets do not handle inflation spikes very well. You saw 2022, dismal for equities and bonds. So that's what I think clients are most concerned about. Are we going to have a repeat of that? Is this geopolitics going to drive inflation?
But I mean, inflation, and it's quite difficult to get a handle on, right? We saw in the markets has seen this like huge volatility because of what we saw in the Fed and that inflation handle. Like, how do you read and look at inflation?
Well, so from an inflation standpoint, the Fed will look at it in different ways. The Fed is all about data. The Fed and ECB are all data focused at the moment, and inflation is really going to drive what happens to interest rates. So from an interest rate perspective, if they see inflation ticking up, CPI, etc., no matter where it's coming from within the inflation buckets, that's going to really impact what happens to rates. So I think this market volatility, the VIX is up, inflation expectations, if they start nudging up, and in the US, that has happened over the last couple of months. So the Fed is stalling slightly, and I think they're going to even be more cautious looking at those inflation numbers and then what happens to rates, both in the US and in Europe.
Eimear, so one of the other things we're trying to explore, and again, it's, I guess, if there is a higher for longer interest rate, and even if the ECB goes first, then Europe will probably be hit the most, and you're also having this gravitational pull towards the Fed. So what does it mean for companies?
So I think from the European perspective, the ECB is going to be focused on, one, what's happening in the Middle East, that knock-on impact on oil, etc., and inflation. But also they're thinking about, OK, if they do cut rates, that's going to impact the euro. So that will essentially be almost importing some inflation into the Eurozone, into companies, and that's going to impact growth. So it's all very secular. So I think companies are going to be under pressure on the inflation side if that does start to tick up, and if we do have higher rates for longer. So, the market is pricing rate cuts in Europe in kind of June, July time. But, I think with this volatility, they're going to be, very cautious on taking a stance, particularly relative to the Fed. They said they're data-driven, not Fed-driven. I love that phrase. But I think they will be really conscious of the currency impact at the moment.
I mean, aren't we all Fed-driven? That's kind of like, I want to be data-dependent, but actually, again, the gravitational pull.
The global impact is
so
huge.
Big.
Yeah,
exactly. China's also quite difficult to read. I don't know if that's deflationary forces longer term, or whether they actually open up and start spending, and so that helps the rest of the world.
Yeah, so China is an interesting one, and I think what happens later this year in terms of US elections is really going to unfold the story with what happens with China. Trade wars is going to be a huge concern if that transpires. You've seen the recent meetings with Germany and China. Everyone's focused on that trade dynamic. And China is a big partner of Germany, so everyone has to manage these conversations very delicately, which is being done. But there would be concern with the US that, if they take a stronger stance on import tariffs, etc., that could create a lot of instability for China. So it actually could be inflationary, to answer your question.
Eimear, thank you so much. Eimear Walsh there from Mercer comes back in a moment, but also we were just mentioning President Xi Jinping has met with the German Chancellor Olaf Scholz in Beijing. The visit comes as tensions between China and the West mount over trade issues and the war in Ukraine. Well, earlier, the Chancellor warned Chinese officials to address overcapacity and treat foreign firms better. Let's bring in Bloomberg's Jill Dices with the very latest. So, Jill, good morning, or good afternoon, actually, where you are. How has Xi responded to criticisms of excess capacity in China?
So, Francine, we've actually seen quite a bit of pushback from Xi on some of these concepts here. The big thing that he really communicated to Scholz in their meeting this morning, it seems, was that China actually has helped lessen global inflation through its exports of a lot of clean tech products. In particular, he focused on lithium batteries, solar panels, that kind of thing. So he's actually saying that really a lot of China's exports on this front have been a really good thing for the world. Again, lowering global inflation, also helped contributing to green energy projects worldwide. So we're definitely seeing that bit of Xi Jinping really sort of hammering home this idea that China wants to fight back against these claims that it has issues with industrial overcapacity, not just from what we've seen out of Scholz during this trip, but also what we saw out of U.S. Treasury Secretary Janet Yellen just last week.
So, Jill, what can we expect in terms of, more? I don't know who the next official to go to China is, but what's China's policy right now in how they're approaching Europe, given what's at stake with the U.S.?
Yes, well, Francine, I think there's a lot on the line when it comes to this relationship with Europe. Obviously, the Germany relationship is one that's critically important. China is Germany's most important trading partner, and there's a lot of concerns over, say, probes into certain things involving China. I mean, we know that, the European Union is probing subsidies for electric vehicles from China. In particular, Bloomberg also reported this week that another potential probe could be launched later this week, involves medical procurement devices involving China. So there's a lot of tensions as it comes to China, because this could obviously result in higher tariffs on Chinese goods. We know that the U.S. is looking into these measures as well as we gear up, especially for the U.S. election later this year. I mean, Donald Trump has said that if he's elected again, he could potentially be floating tariffs as high as 60% on Chinese goods. So there's a lot at stake in these relationships going forward. I'm sure China will be looking out for any of these further visits to try to temper down some of these, really these big concerns around geopolitical tensions right now.
Jill, thank you so much. Jill Dice is there in Hong Kong for us. Now let's bring in back Eimear Walsh, Mercer's head of investments for Europe. Eimear, we were talking a little bit about the markets today, which, simply put, strong dollar, firmer treasury yields, weaker stocks, higher VIX. Does multilateralism actually hurt inflation? Again, because we're in this fractured, fragmented world, what does that do to your, what your take on European inflation is?
So I guess from client portfolio perspective, we are thinking about inflation and the damage it will do potentially over time to their investment objectives. But what we think will navigate that to the best extent is more diversification across asset classes. So back in 2022, bad year for equities and bonds. So 60-40 portfolios really struggled back in 2022. So having that diversification in portfolios is critical, and I think even more so at the moment. So not only equities, bonds, alternatives, private markets, that's an area that has a huge focus at the moment. And, a lot of clients, they are accessing that return, that liquidity, that illiquidity, and also just benefiting from their overall diversification in their portfolio. So I think diversification is kind of our response to navigate those inflation challenges. And I know private markets, the IMF came out recently and talked about, potential systemic risks, etc., associated with it. But there are nuances to the asset class. But I think overall, particularly when this inflation spikes, it plays a really strong role in the portfolio.
Eimear, thank you so much. Eimear Walsh from Mercer stays with us. Now, coming up, Israel vows to respond to Iran's attack over the weekend as the West calls for restraint. Details next, and this is Bloomberg. So the U.S. House is set to vote separately on new aid to Israel and Ukraine this week following Iran's missile and drone attack over the weekend. Meanwhile, top Israeli military officials reasserted that their country has no choice but to respond to Iran's weekend attack. Well, joining us now is Bloomberg's EMEA News Director, Rosalind Matheson. Ros, thank you so much for joining us. Is the risk rising of an Israeli strike against Iran?
Well, it's very clear from all the different officials we've heard from in Israel, right to the very top, is that they feel that they have to do something to retaliate against Iran for the strike that Iran did on Israel a few days ago, that they feel compelled to take some sort of action. The question, of course, is what does that action look like? There's a range of options for Israel that really kind of small and calibrated versus the sort of action that could trigger further reprisal from Iran. And then we're in this period of endless tit-for-tat attacks between the two countries, risking that broader conflict that everyone's worried about, that we're seeing being reflected in markets at the moment, FX, oil, stocks, everything getting jittery about the geopolitical outlook. And then the possibility of that wider conflict pulling in actors like the US. So really it depends on the nature of the response that Israel says it decides to do. But we can see from the rhetoric from Israel that despite the calls from the US and Europe for restraint, that Israel says this attack, unprecedented by Iran, from Iran straight to Israel, does require some kind of response.
But so, Ross, first of all, what could a potential retaliation look like, and where does that leave the U.S. that wants to try and de-escalate?
Well, it's possible that Israel opts to do something just in the cyberspace, which we might then not know about for some days or even weeks after. They might do something just in cyber. They might target one of the proxies for Iran in the region, so they might hit some of those proxy sites for Hezbollah, the Houthis and so on. They might try that also in places like Syria. So there might be that kind of asymmetric response against some of those proxies. The big thing would be to hit Iran directly. Of course, Israel has done that before in the past, but in this climate, that's the sort of thing that would trigger a further response, and particularly does that include targeting Iran's nuclear sites, which is the ultimate one for Israel. But of course, what we've got now is the US urging caution. If Israel does go ahead, depending on the size of the response, that puts the US in a really awkward spot, because they are a key ally of Israel. They support it militarily, but they're obviously highly concerned again about the possibility of that broader conflict that would pull it in the Middle East.
So, but is there anything, Ross, actually, that the U.S. can do to, again, try and persuade Israel? Will the U.S. keep selling weapons to Israel?
Well, at this point, the US has said that it will continue to support Israel militarily. That includes sending it weapons and selling weapons to it. But we can see from the past couple of months that really Israel isn't listening to the US anymore. We know that Israel did not tell the US that it was going to, according to Iran, strike the Iranian diplomatic compound in Syria. The US got no advance warning that that was coming. We can see, despite the entreaties on Gaza, that the Israeli administration say that they still intend to go into Rafah in the southern part of Gaza at some point, because they say they need to try and eradicate Hamas in that area. And despite all those concerns, all those phone calls between the leadership of Israel and the US, Israel's been pushing on regardless. So again, what can the US do here for leverage? The big one would be to stop selling them weapons, but the US has made clear that they will continue to do that, at least for now.
Ross, thank you so much. Bloomberg's Rosalind Matheson there with the very latest, of course, on the Middle East. Let's bring back Eimear Walsh, Mercer's head of investments for Europe. And Eimear, this goes back to, the idea of how do you deal with all this geopolitical risk? Because it's extremely volatile, impossible, frankly, to price. I mean, worst case scenario is almost unthinkable. So what does it mean for investors?
So I think it is worth putting it in perspective. So for medium, long-term investors, we try not get too concerned about this short-term volatility. It's really about checking in on their overall portfolio, their overall strategy, making sure that they have the right diversification in there, both on the liquid and the illiquid side. On the liquid side, across regions, across sectors, different types of stocks, be that growth and value, but then on the illiquid side through the private markets and the alternative space.
Yeah, and the private markets, and this is a point that you were making, that actually the private markets are getting a lot more accessible. But with that, is it also more risk?
So what's happening in the industry is there is a democratization of private markets. So historically, this asset class has been reserved for the larger institutional asset owners because there's high barriers of entry. But actually technology and solutions, we're working with a lot of wealth managers on how retail investors can access through their products. So it's quite an exciting time because it makes it more accessible. But as you said, there are nuances and there are risks. And I think the biggest risks is, one, the appropriateness of the asset class. Is it right that investors go in there? And two, that the liquidity mechanisms are understood and appropriate for that client. So I think it's a great asset class, particularly to shield from short-term volatility, because pricing is lagged. You won't see the impact of this short-term vol on your illiquid or your private assets at the moment. Over time, it could feed through. But from an overall total portfolio perspective, it's really good to create robust outcomes.
I mean, is it, we're talking about higher for longer interest rates. So I don't know what that means for private markets. If this is, their moment where people go in, or whether actually you just wait a little bit to see where rates settle.
So from a rate expectation, a lot of people actually are concerned on the private equity side that higher rates will impact borrowing, will impact returns. But actually what we've seen in the past, if you look at the 2000s, there was high rates and there was actually record returns on the private equity side. So it's not at the point of entry, it's actually at the point of exit, which is really going to impact your return. And again, it's the diversification across private markets. So if you look at something like private credit, concentration is what's going to kill you in that asset class. You really need to be diversified across sectors, managers, year diversification. So I keep saying the point diversification, but in these market volatility times, that is what's going to protect the assets and withhold value in investors' portfolios.
But in private markets, is it a tougher sell actually in Europe because it's not as mature? The market's not as mature. It's almost much more nascent than it is in the US.
Yeah. So fundraising struggled last year slightly, and I think that's because of higher rates, and also a lot of investors were over committed relative to their target. But in Europe, it's a really growing area. We look at what large asset owners are doing and where their capital is flowing, and a lot of them expect to increase allocations to private debt, to infrastructure. There's a lot of interesting innovation happening in Europe, probably more in the US on the VC innovative side. As we mentioned earlier, Europe does need to invest in innovation to keep up with the growth projections that it needs. But I think Europe can do really strongly in the private market area.
Okay, Eimear Walsh, thank you so much for joining us. She's, of course, from Mercer. We'll have plenty more of the day's top stories and interviews next. This is Bloomberg.
India's elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins April 19th.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, for some other stories making news today, and the chief of Google's AI business says the company will eventually spend more than $100 billion developing artificial intelligence technology, another sign of the investing arms race that's gripping Silicon Valley. Donald Trump's first criminal trial got off to a slow start, with the proceedings stalling over disagreements about evidence and other last-minute arguments. Now, jury selection did not kick off until the final hours of the day, as the former president's lawyers argued with prosecutors over which evidence will be admissible. Now, more than half of the first panel of 96 potential jurors had to be excused after saying they could not be impartial. And two of Tesla's top executives have left the company as the car maker holds its largest round of job cuts, while the senior vice president, Drew Baglino, confirmed an earlier Bloomberg report about his departure. Now, the vice president of public policy and business development, Ron Patel, also announced his exit. Tesla is looking to reduce its global headcount by over 10%, which could affect some 14,000 employees. Now, here's what we're looking out for today. 1:30 p.m. UK time, U.S. housing starts. 2:12 p.m. London time, U.S. industrial production. And then after hours, we have LVMH sales, and then later U.S. earnings from Bank of America, Morgan Stanley, United Health, Johnson & Johnson. And, of course, we'll have throughout the day some central bank policymakers. Coming up, plenty more. This is Bloomberg. The dollar rallies against all of its G10 peers, sparked by geopolitical tensions and the prospect of rates staying higher for longer. The latest data out of China suggests the economy is still struggling as the German Chancellor Olaf Scholz takes a tough stance in a trade meeting with President Xi Jinping in Beijing. Plus, Israel vows to respond with senior military officers saying the country has no choice but to hit back against Iran. Allies are urging restraint. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the New York Fed President John Williams believes the U.S. Central Bank will likely start cutting rates later this year if inflation continues to gradually ease. Now, he also discussed resilience in consumer spending in an exclusive conversation with Bloomberg TV.
Consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So, yes, it's part of that story. But, I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think, consumers are spending.
What's the thinking in your office and among your colleagues about, does this last? Or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year. Probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place. Probably not as rapid a growth as we saw last year.
You do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where the rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. Now, my own view is that that process will likely start this year, but again, it's going to be driven by the data and achieving our goals.
Well, that was the New York Fed President John Williams speaking to us exclusively. Meanwhile, the San Francisco Fed President Mary Daly also reiterated there's no urgency to cut interest rates.
The worst thing we can do right now is act urgently when urgency isn't necessary. The policy's in a good place. We're in the ready position. We can respond as the economy evolves. The labor market's not giving us any indication it's faltering, and inflation is still above our target, and we need to be confident it is on path to come down to our target before we would feel the need, and I would feel the need, to react.
The San Francisco Fed President there, Mary Daly. Now, the dollar rallying against all of its G10 peers, sparked by geopolitical tensions and the prospects of rates staying higher for longer. With us now, Bloomberg's FX and rates editor, Aline Oyamada. Aline, thank you so much for joining us. The dollar up a fifth day, the longest winning streak since January. What's exactly behind the rally?
So like I said, it's all really playing in the favor of the dollar. You have this whole story of the Fed will take much longer to cut than initially thought. And it all started last week, remember, with that very hot inflation print. Then retail sales came. They were also strong. It all reinforced this new trader view. And then on top of that, you have geopolitical tensions, which are always kind of a boost for the dollar. It's the ultimate safe haven. So this is what we are seeing really now. No one really wants to bet against the dollar. And it's actually interesting that this is bringing up volatility to the currency market, which was dead for quite some months. Like we were all even discussing if that was the new normal for the currency market. So things are starting to pick up again.
So, Aline, I mean, this is quite painful for certain parts, especially like FX in Asia. What are we seeing there?
So in Asia, I think you have some very some kind of weak links. One is the yen. Obviously, it has been weak for so long, and we are just waiting for intervention for quite a few weeks now. I guess the big point there is when will they really step in and what will it take? We were watching that 152 level. We crossed that after CPI because it was very gradual. So now we are starting to see people saying, oh, maybe it's 160 or 155. It doesn't really matter actually the level, but as the pace of that move. And as long as it's driven by the dollar and kind of an orderly move, maybe they will just wait and see. And then you also have other stories in Asia, like the yuan, that China did a weaker fixing for the currency, and that also drove some negative sentiment in Asia. But overall, many EM currencies and even DM currencies have fallen to like the weakest levels this year.
I mean, I know there was so much focus on the yen. I mean, could there be some kind of, how much intervention are you expecting actually from central banks? And you put it correctly, a lot of the times it's not really the level, but it's the pace at which these currencies move.
Yeah, so it's really tricky. There's no, I think, estimate for how much they would spend because it would depend a lot on the speed. But what we hear is around the same that they spent last time. And then there's also talk about how they would combine policies to do that, obviously, because it's not just currency, not just stepping in and buying, but also like interest rates are a big factor. As long as interest rates in Japan are so low, you will always have people betting against the yen. So when will the BOJ move? And that's the biggest question maybe for the year also.
That is a big question. Aline, talk to me about pound. So we're sterling obsessed. Like, what are you seeing there?
So the pound is another weak story in the recent weeks, but it's a slightly different one because it actually started the year very strong because everyone expected the BOE, because inflation in the UK is so high, the BOE would take longer to cut interest rates. And then it slightly changed a bit when we saw some softer prints, and then the US were pricing toward fewer cuts. And now it's starting to look that maybe the BOE could move before the Fed. And this is obviously not good for the pound. And on top of that, we had the market super bullish on the pound. So some people started to say it's expensive, positioning was kind of stretched, and this is all kind of like gradually dismounting. And obviously the pound is feeling the pain now.
Yeah, and I don't know whether it complicates it for the Bank of England. I mean, if you speak to the governor, he says, no, we're not looking at the pound.
Yeah.
You know, for that's definitely not my remit. But at the margin, it makes a huge difference for, you know, importing and exporting and therefore GDP.
Yeah, it does. It definitely has an impact. I would say at this very moment, it's not the most like crucial thing for them to watch because it is coming off a very strong level.
Yeah.
So wages growth, like we saw today, which was above estimates, that's like those are the real things that they are really looking at and will make a difference in what markets are betting to.
Aline, thank you so much for joining us today. Aline Oyamada there with the very latest on some of these big currency moves. Now, a reminder, we'll also be speaking with the UK's Chancellor of the Exchequer, Jeremy Hunt, on the outlook for the British economy. That's just after 7 p.m. UK time. Coming up, we take a look at the rising demand for premium skincare with the global brand president for Clinique and Origins. That's next, and this is Bloomberg. Now, the conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacroix here in London. Now, skincare is a top revenue sector for Estée Lauder, reflecting rising global demand. Its Clinique division also debuted on Amazon as it seeks to redefine its brand for the future. Well, joining us now is Clinique and Origins Global Brand President Michelle Freyre. Michelle, thank you for joining us. I mean, skincare, I don't know whether it's having a revival or certainly everyone's talking about where you know, this is where you can make quite a lot of money. There's a lot of also you know, companies trying their hand at that. Mm-hmm. What kind of growth are you expecting in the industry?
Yes, we are seeing very strong, healthy growth in prestige beauty around the world. We saw a huge acceleration of skincare growth during COVID. And consumers are more and more educated about their skin, and skin is now really more about skin health. And then post-COVID, then we saw a bounce back also to makeup, but makeup influenced by skincare. So we are seeing really strong, healthy growth, and we're really excited to see how consumers are just educating themselves more, and we. In Clinique, education is core to the brand, so we really take pride in educating consumers about their skin health.
So, Michelle, I mean, Clinique is one of the names that everybody recognizes. It's been around for a long time. It generates quite a lot of revenue. What do you spend most of your time thinking about? Is it how you position it? So you talk about prestige, which is not quite high-end luxury, but it's kind of like prestigious. Is it pricing or is it distribution?
Yeah, no, Clinique, it's really more about the consumer. We're always thinking about the consumer, where the consumer is going. The space that's very much growing is the space with dermatologist brands. And Clinique was founded in 1968 by a world-renowned New York City dermatologist. Today, Clinique is still dermatologist guided, and we offer safe clinical solutions that deliver on the highest level of efficacy with the most rigorous safety, which consumers are really looking for.
But, Michelle, there's so many new entrants as well. So how difficult is it to actually fend those off? And does it really depend on how you position yourself? And so I know it's quite exciting that you're selling on Amazon. What was the decision behind that?
Yes, we are selling on Amazon. We just launched in the U.S. only. And that is really about expanding our consumer reach and making sure that we continue to speak to and appeal to broader consumers in the U.S. And we're doubling down on our authentic dermatologist heritage, and so consumers can come. We are launched on the Amazon premium store, and so we have a branded storefront where you can come, you can get personalized solutions. We partnered with our guiding dermatologist to create a Clinique skin analysis tool where you can get personalized recommendations, and you really learn about the Clinique dermatologist guided solutions that we offer for skincare, but also makeup. So Clinique is the only dermatologist brand that offers makeup. We offer dermatologist developed foundations. We offer our eye makeup is backed by our eye safety promise, which means that all our eye makeup is safe for sensitive eyes, safe for contact lens wearers. All of that is on Amazon. You can learn about that.
I mean, it's amazing that actually you've decided to partner with Amazon. And again, is that because it takes away the pain of actually reaching consumers? Or were you ever worried, like, talk to me about the discussions, were you ever worried that by being on Amazon it cheapens it? Or are the benefits of actually reaching a wider, consumer audience 100% worth it because Amazon is also changing?
So Amazon has really evolved in the last few years, and so their premium store now allows brands to offer an elevated experience, which is really important to us, and allow for these personalized tools for education. So just the overall experience on Amazon is you're not compromising as a brand. You're able to deliver on that elevated experience and personalized recommendations that consumers are looking for. So it is a place where we felt like we could really double down on our authentic derm heritage and offer that to consumers.
So, Michelle, what's next for Clinique? Is it, I know you're also selling to men, and actually that demographic has really come on to skincare, which is basically untapped revenue. There's concerns that teens and tweens are starting into skincare. Like, how do you see that evolving?
Yes, definitely we see that. We take that very seriously. Safety is such at the core of Clinique, and we just make sure we have, here in the UK, we have 900 consultants. So we have, Clinique has consultants that are clinical consultants trained in partnership with dermatologists. So we make sure they're trained to offer recommendations for any age, any skin type, whether it's men, women, young teens, older women, which is really the beauty of Clinique, and we can offer those safe clinical solutions no matter what your age is.
What region is doing the most? Is there an appetite for skincare in a region that's going better than others? I don't know whether the U.S. is leading or whether, for example, it's in Asia, or how you see that changing.
Yeah, absolutely. I mean, the U.S. And the U.K. are core heritage markets for us, must-win markets for us. And then we're also seeing an explosion in Asia, in India, which are also markets that we are also scaling. But the U.S. and the U.K. as our core markets remain must-win for us, and where we know that we can really, truly serve the Clinique consumer.
Michelle, I imagine that AI plays a huge part in also being able to do all of this dermatology and skincare. I mean, is it really changing to the point where you buy a foundation online, it's the right color, and how much investment and how much attention are you paying to AI to be able to sell the right things to the right people?
Yes, I'm so glad you're asking that question because we are investing a lot of time in that. First of all, we're seeing sensitive skin is a huge global phenomenon right now. It's on the rise. 71% of consumers around the world say that they have sensitive skin. So personalization is more important than ever. And so we actually are rolling out right now an AI-powered diagnostic tool to offer those personalized recommendations. And what is so great about it is that it has 55 years of our dermatological science and research and the data of 3 million face evaluations that we've conducted over the years. So it scans your face, but it doesn't just take what it scans. It also then takes all that information of the 55 years of science with the 3 million face evaluations to give you the most personalized recommendation. You could do it on your phone, like go on our brand.com and do it, but if you go to the store, the clinical consultant who's trained on that partnership with dermatologists can also help guide you.
And Michelle, how sensitive are your consumers to price increases and price change? And so we're seeing cost of living pricing, we're seeing inflation, but I imagine your supply chains and your ingredients are also getting more expensive.
Yeah, absolutely. I mean, consumers, yes, as you say, are very sensitive, but it's really more about value versus price. And I think consumers are very engaged in beauty, in skincare, and so to them, they want approachable solutions, that are affordable, but it's about the value. So they want to still make sure that they're getting products that are from brands that they trust. Yeah. They're willing to pay for that, and they're willing to pay for what they know is going to be good for their skin.
Michelle Freyre, thank you so much for joining us today. That was the Clinique and Origins Global Brand President, Michelle Freyre. Coming up, another big week for U.S. bank earnings with Goldman Sachs closing a little bit higher after posting a profit jump. We have Bank of America and Morgan Stanley still to come. That look ahead is next, and this is Bloomberg. The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, U.S. bank earnings season continues. Bank of America, Morgan Stanley due to report later. Now, Goldman Sachs shares closed higher after the lender posted a surprise profit jump in the first quarter. Now, let's bring in Bloomberg's Jenny Serrain, who, of course, leads our coverage here of European banks. Okay, we're almost there. It's been like a big week for earnings. Goldman Sachs, much better than expected. I mean, was it all about trading, or what's driving this for them?
Yeah, I think, with the results yesterday, it was certainly all about trading. And so they beat on both the fixed income trading side and the equities trading side. And it just looked like a really all-around good quarter for them. If we remember, they're kind of going back to their roots right now. So they had this years-long foray over into retail and consumer banking. They're pulling back on that now. They're really focusing on what Goldman's known for. And that just really shined through yesterday, and the stock reacted accordingly.
And the chief executive, Dave Solomon, has been in a spot of trouble. Maybe that's the way to put it. Do these numbers really help him?
I think so. It'll be interesting to kind of see. One thing that we've been reporting a lot is they've had a retention problem. So they've really lost a lot of senior talent. They've seen a lot of partner churn. That's really unusual for a firm like Goldman. Historically, they aren't really seen as a place that kind of people shuffle in and out of. And so I think, when you've got results like this, it just makes that argument for him so much easier when he goes to these senior folks and says, no, believe in the cause, believe in the case, we're doing it, we're kind of making this progress that we need to make. So it should help him, but it's always hard to know if one quarter really makes a trend.
So today we also have Bank of America, Morgan Stanley. What are you most excited about? Morgan Stanley's quite exciting because you have a new chief executive in charge.
Yeah, no, I think it'll be interesting. So Ted Pick's first rodeo at the earnings front, or at least his first full quarter, I guess, in the seat. And so I think it'll be interesting to kind of see how he handles things. Maybe it'll be a little bit different from the way James Gorman historically did. Trading is such a hard thing to read across. So just because Goldman had really strong results there yesterday, it's hard to know if Morgan Stanley will show the exact same results. But I'm sure, with Ted Pick at the helm, he'll be looking to kind of point out all of the strengths that they've had in the last few months. So it'll be a good one to watch for sure.
All right, Jenny Serrain, on top of all of these earnings, and then it quietens down until we actually get into what's happening here in Europe with UK banks. So, keep on watching and following Jenny and her team's great stories. Now, coming up later today, the Bloomberg Technology team will speak to Merit McGuinness, the European Commissioner for Financial Services and the Capital Markets Union. So don't miss that interview. We have plenty more to come. Markets getting a little bit of a hit, certainly here in Europe. Now, if you look at what the worries are, first of all, there's U.S. rate angst. China's sluggish economy is also something that they're worried about. And then geopolitics back at the forefront with a possible Israeli counterstrike. So on the back of that, you can see gold 2,368 when it comes to U.S. dollar. We chose the Bloomberg U.S. dollar index 1264. Up next, to Bloomberg Brief. Danny Berger and Manus Craney have all of your stories from New York. This is Bloomberg.